You know, in finance, there's always the price you see, and then there's the price you actually pay. Today, we're going to pull back the curtain on enterprise value. This is the metric that shows you what a company is truly worth, way beyond just its flashy stock price. Let's get right into it. So, here's our roadmap. First, we'll talk about why a company's sticker price isn't the whole story. Then, we're going to build the formula for its real cost, piece by piece. After that, we'll see why the pros use this as their go-to tool. And finally, we'll cover the really important part, when this number can actually lead you down the wrong path. All right, let's dive into our first section, beyond the sticker price. It all starts with a really simple question. When you look at the total value of a company's stock, are you really seeing the full price tag? Okay, imagine this for a second. You've got your eye on a company, and you see its market cap, the value of all its stock, is $5 billion. So, is that what you pay? Is that the final number? Well, the short answer is almost never. And that's exactly where enterprise value comes in. See, it's not just some dry formula. It's a whole concept. It really represents the total economic cost someone would have to shell out to own the entire business. And that includes being on the hook for all of its debts and obligations. I think the absolute best way to get this is to think about buying a house. A company's market cap, that's kind of like your down payment. It's the part you're buying outright. But the enterprise value, that's the total price of the house. Because guess what? When you buy it, you also have to take over the mortgage. That's the full cost of what you now own. So how in the world do we calculate this real cost? Well, in this next part, we're going to break down the enterprise value formula from the ground up so you can see the logic behind every single piece of the puzzle. Here's how a potential buyer would think about it. First, you start with the equity value, or market cap. That's the cost to buy out all the existing shareholders. Simple enough. Next, you have to add the company's total debt, because once you own the company, that debt becomes your problem. But here's the good part. You get to subtract all the cash the company has on its books, because that cash now belongs to you. And finally, you add in any other big claims on the business, like preferred stock.
And this really gets to the why of the whole thing. Equity value is what you pay the old owners. Total debt gets added because you inherit that big IOU, and cash gets subtracted because it's an asset you get right away. You could literally turn around and use that cash to pay down the debt you just took on, which effectively lowers your net purchase price. It just makes sense.
Okay, so why do finance pros and Wall Street analysts obsess over this particular number? In this section, we're going to see why enterprise value is really considered the apples-to-apples gold standard for comparing companies. And here it is. This is the secret sauce of enterprise value. It lets you look at a company's core business value, no matter how that company decided to finance itself, whether it's loaded with debt or has none at all. This is what we call capital structure neutrality, and it is absolutely the key to making a fair comparison. Let's just put them right next to each other. Market cap, it only tells you the value of the stock, and that number can swing wildly depending on how much debt a company has. Enterprise value, on the other hand, gives you the value of the entire business operation for everyone who has a claim on it. That's shareholders and lenders. That's what makes it a much more solid, reliable way to compare companies. Okay, enough with the theory. Let's make this totally real. We're going to do a quick case study with Macy's, and you'll see just how massive the difference between the perceived cost and the real cost can be. All right, first up, the sticker price. Based on its stock, Macy's market cap was sitting around $5.13 billion. That's the big number you'd see on the news. But a buyer has to deal with Macy's net debt, which is its total debt minus whatever cash it has. And that adds almost another $2 billion to the actual price tag. So you do the math, and the real cost to buy Macy's isn't $5.1 billion, it's over $7 billion. That gap, that nearly $2 billion, is all debt. It completely changes the picture. And that is why enterprise value is so important. So what do analysts do with this number? Well, they turn it into these powerful comparison tools we call multiples. They'll compare enterprise value to things like EBITDA, which is a proxy for cash flow, or to revenue, to see how it stacks up on sales. A lower multiple might mean a company is cheap compared to its peers, while a higher one could mean investors expect big growth. It's the language they use for valuation. But look, like any tool, enterprise value isn't a magic wand. You have to know its limits. So in our last section, we're going to look at those critical situations where the numbers can actually fool you if you're not careful. Let's start with the biggest, brightest red flag there is. You should never, ever, ever use enterprise value to analyze a bank or any other kind of financial firm. It doesn't work. And here's why. It's actually pretty simple. The whole idea behind EBITDA is to separate a company's business from how it pays for that business. But for a bank, debt isn't just financing. Debt is their business. It's the raw material they use to operate. So the whole model just completely falls apart.
And, there are other little nuances the pros always keep in mind. It can be really tough to figure out the true market value of debt if it's not publicly traded. You also have to make careful adjustments for things like operating leases or any assets that aren't part of the core business if you want to get a truly clean number.
So let's bring this all home. What's the big takeaway here? After all this, it should be pretty clear that enterprise value isn't just another number you plug into a spreadsheet. It's really a total shift in perspective. It forces you to look right past the daily noise of the stock market and see a company for what it truly is, the raw economic value of its core business engine, completely separate from its financing choices.
And honestly, understanding this perspective is the absolute bedrock for any serious work in mergers and acquisitions, corporate strategy, you name it. It's really the starting line for asking the right kinds of questions.
So the next time you see a headline screaming about some company's multi-billion-dollar valuation, you'll have a new tool in your belt. You can pause for a second and ask the smarter question. Yeah, but what's the real cost?